Howdy, everybody. In today's teaching lesson, we're going to learn about univariate and multivariate time series analysis. So I did another video on time series using 7 different time series models. I looped through the 7 and showed the performance of each one and compared each to all its peers. So this is another time series analysis video. The takeaway is going to be slightly different, but kind of similar to what the other video was about. So if you like this one, you can check out the other one. And if you like the other one, you can check out this one too. So univariate is uni meaning one, right? We just look at one single feature in the time series. It's going to be, in this case, it's going to be stock prices. We're going to look at trend identification, try to understand, is there some kind of anomaly, deviation in the price of these stocks over time, understand any kind of seasonality detection, and stock prices, they're not so seasonal. In retail sales, it's certainly seasonal. You'll see spikes at Christmas time and at Thanksgiving time, Black Friday. So you'll see seasonality, trends and patterns, not so much in stock prices, but in some time series scenarios, you'll be able to understand forecasting and make predictions. Again, anomaly detection can be very useful. Any kind of data transformation or shifting of data or differencing. You can do leads, lags, moving averages. So all those can be helpful to understanding the movement of a time series pattern. And then multivariate time series analysis, we have multiple time series features that we're looking at simultaneously. We'll see an example of that in a few minutes. This can be useful for joint forecasting, facilitate forecasting of multiple variables together. Do certain variables impact other variables? Any kind of auto regression, we can analyze that. So does the features have influences or impact other features? We can look at causal relationships between different features, and then that can help us make improved, accurate estimates and forecasts into the future, and it can help us understand complex patterns in the data as well, right? So there's multifaceted types of analysis we can do here, and we can extract very useful information from that. Okay, so let's jump into it. We have a univariate time series analysis scenario right here. I almost call it experiment. I don't know if this is a real experiment per se. So we're pulling in information from Yahoo Finance. Okay, they source it from Capital IQ. Capital IQ gets closing prices from the market every day. They have some pretty powerful machines that go into the market, check the price at the end of the day, and save it down. And they've been doing this for years and years and years. They have, I don't even know, history going back easily 30, 40 years if the stock was trading back then. Some stocks are newer. They just don't have that kind of deep history. But if the stock's been around, I think Coca-Cola, IBM have been around for decades, right? So they'll have all that information. So some of it is pretty deep and pretty rich and very interesting as well. So we load the historical stock data, right? We went back, in this case, 6 months from today. I'm getting the time now. If you look at the mouse, I'm looking at the time now, and I'm going back in time 6 months. Okay, so we go back to February 26, 2024, and today is August 26, 2024. So there is the 6 months, right? And you can see I'm printing the begin and end date. So the begin date is 2/26, and the end is actually tomorrow. We don't have the data for tomorrow. I guess it's looking one day ahead. Time delta days, maybe that's coming from here. I just noticed that. I want to take us off track. It does look like it's going one day ahead, I think, because of that. I don't think we really need that, but that's fine. We're not going to have any relevant data, and that's not going to have any impact whatsoever. So let's look at the first example here. This is a ARIMA model. So you can go ahead and run this. This is pretty standard autoregressive integrated moving average. Like I said in my other video, there's at least 7 time series models. This is one of the more popular ones. So this is a moving average model where you're looking at the averages over a period of time, not just one specific point in time. We have a few metrics down here: the coefficient standard error, the probability of z being greater than the threshold here is 0.05. So anything greater than 0.05 is going to be considered significant. So this moving average is significant, and this autoregressive L1, level 1, is significant, right? It's greater than 0.05, and a low z score will signify the same thing, and a high standard error, right? So anything over 1.96 is considered statistically significant. This exceeds 1.96, and this exceeds 1.96. So these are significant. Sigma is not significant, right? The p-value is very low. You need at least 0.05. And this is a low standard error, negative 0.0002, it looks like, with a negative exponent there, e to the negative 0.05. So let's go down a little bit. What does all this mean? We can interpret this here. This is an ARIMA model. The P is the order of autoregressive parts. This is the AR is short for autoregressive. D is the number of differences to make the time series stationary. Q is the order of moving average. So the MA is abbreviation for moving average. Log is the likelihood, 341.18. I'm looking for that. Where's the log? 331.8 is a measure of the likelihood of the model to show its data, and higher values indicate a better fit. 341, but I'm not seeing the 341. Sorry, let me pause for a minute. Where's the 341? I do not see that. I do not see. Oh, here it is. Yeah, okay. Upper right, 341. Okay, so higher is better. So that number is high. So this model is doing a pretty good job. It's pretty accurate. It's able to understand the time series, and we're going to use that to make some predictions in just a minute. Just let me go through a couple more metrics here. AIC is alkaline information criterion. Lower is better. We have a negative 676 right underneath the log likelihood. BIC, lower is better. Negative 667, 672, lower is better. So you can see my notes here. I'm going to share all of this when I post the video. You can have all the notes, so you have all the interpretation here. I'm not going to go through all of these because the video will drag on and drag on and drag on, and I don't think people want to see that, but all the notes are displayed here. I will share this when I post the video, so you can download the file as an HTML file. Double click it after you download it, double click it, and you'll see exactly what I'm seeing here. Okay, so you'll have everything, and this data is dynamically imported from the web, so there's no data source I have to share from you. You can go ahead and click in the cell to refresh it and run it, and you'll get exactly the same output that I'm seeing here. Okay, so we have the forecasted dates. We are going to go ahead and plot the results. I would say a picture is worth 1,000 words. When you have your plot or your chart, you have a visual representation of what the data is doing. You see the historical stock price for Apple, and we see the forecast into the future. So it could go up, could go down. We have some confidence around that, but the forecast is kind of ambiguous too, right? Because with the stock price, anything can happen, right? Apple can have a huge quarterly earnings report, and it's very positive. They beat expectations, and the stock is going to jump up on that news when it comes out. Or they miss expectations. They miss the quarterly expectations. They have to announce that to stockholders, and when they have the earnings call, people are going to be angry, and they're going to beat up the stock and sell it so the price can go down. So anything can happen, right? You don't know exactly what's going to happen with these stock prices. If this was more like retail sales or weather patterns, that deviation there would be much tighter. It would be more clean and crisp, and you can make more accurate predictions. With the stock price, it's very hard to do this with a time series type of model. I do have some models and other videos where I explained using random forest regressors, how to make pretty accurate stock predictions, right down to the dollar, almost to the penny. They're very accurate. So check out those other videos. Let's go down to another example. I think we are making predictions here. Okay, so whoops, let me go up. Computer's running slow today. So day 127, 128, and so on and so forth, down to day 141, we're predicting around $227. The average forecasted price. Let me go back and see what it was today. Actually, well, today is today, right? Let me see what this was. Apple Finance. Okay. So let's see. Finance. I must have spelled it wrong. Yahoo. Oh yeah. Gotta spell it right too, guys. Computer does exactly what you tell it to, right? You give it a mistake, it makes a mistake. Okay, so let's look at Apple. Lots of news here. Lots of news. AAPL. Okay, let's see what it was today. Something. Okay, AAPL. Didn't catch it. Okay, now we have it. So let's say 227. That's what it's telling us, right? And the stock's at 227. Okay, so that's fine. So the model is not predicting much of a stock change over the next couple of days, and that's fine. These stock prices are notoriously difficult to predict. Prices are very hard to predict. Price movements are probably a little bit easier to predict, but still very hard to predict those. But you see the lower estimates here. So you have a lower bound, 220 down to 216, down to 210 even. It even goes lower down to 199, right? Up to 258. So most likely, probably it's going to be hanging around 227 for days 127 to 141, with a lower estimate, maybe 220, upper estimate, lower threshold 234, but could go as low as 199, right? If Apple starts to tank, it could go from 227 down to 199. But on the upside, it could go as high as 258. That's what the model is telling us. Okay, so it could be anything in between. Again, stock prices are notoriously hard to predict. So we have a range and we have a confidence interval there, but do we know the exact price? No, we don't. If this is retail time series analysis, those numbers would be much tighter because retail is more consistent, more persistent, more predictable. There's seasonality changes, like I said before, with the holidays, Christmas and Black Friday for Thanksgiving. Those are big ones, but those are pretty predictable. Stock prices, the swings and deviations are pretty massive here. Let's look at an example of multivariate time series analysis. Again, we're going to look at our good old friend Apple stock. We're going to download it from the web. I'm going to share all this data with you so you can copy and paste it and do this in your own Jupyter Notebook environments. Okay, after the video, I'll post all the source code online. And now we have a few more variables here. So open, low, close, and then volume traded, right? And we're looking again at the standard error. So anything over 1.96 is considered statistically significant. Otherwise, it's not. Okay, so we look into T statistics. So none of these are, this one would be 4.6. So that is considered statistically significant. So we're saying the closing price is very significant to the price. That makes sense, right? The closing price every day is going to be literally the price, and the T statistic represents that. Highly significant. 4.6, anything over 1.96 is significant, but nothing else is. Open, low, close volume really doesn't matter. It has no influence on the stock price whatsoever, right? And you can see that whatever the market opens at or closes at, that is open and close. It has really not a lot to do with the price. If it opens at a certain price, 100, it could go to 150 during the day. It could go down to 50 during the day. If it opens at 100, if it closes at 100, overnight trading could go crazy, right? The next day it could open at 150, it could close at 100 and open at 150. There's no relationship between those two, right? What happens between the open and the close is the stock price. What happens between the close and open really has nothing to do with the stock price, because that's aftermarkets trading, right? And international trading. So there's the multivariate analysis. Again, we get the interpretation of results coefficient 0.332474. Let me find that. 0.332474. There's a lot of numbers, so let me see if I can copy and paste that and search for it. I bet I can. Control C, Control F. Yeah, I found one. Oh, there's only one. There's only one. The one I just searched for. Okay. Well, let me go up to coefficient if I can find a coefficient. Oh, you know what? I think this was a change because I ran this model a couple days ago and I just refreshed it and just reran it with today's data. So the coefficient is slightly different, 0.3112. And before we had 0.34, right? So it's fine. Those are going to change as the data changes. But this basically shows you the expected value. And all are lagged. All lagged values are 0. The standard error shows the variability and the constant estimate. The t-statistic shows a significant difference from 0. So again, anything t-statistic that has 1.96 or greater, or negative 1.96 or lower, that will be significant. So this will be significant, and this will be significant for volume, and none of the others are, right? It has to be 1.96 or greater, or negative 1.96 or lower, okay? So conclusion here, the variables are lagged. That's the L1, lag 1 close. It has a significant effect on the open price, okay? So what the stock closes at is kind of close to what it's going to open at the next day, but it's not necessarily going to be the same thing, right? There's overnight trading, there's aftermarket trading, international trading, and the book is passed around the world when the US market is closed. So the close and the open are going to deviate, sometimes greatly, sometimes just slightly. But that does seem to have an effect on the opening price, according to this multivariate time series model. And non-significant variables, we're looking at constants, lag, open, high, low, volume are not significant predictors based on the p-value, right? So we're looking for low p-value, less than 0.05, or high t-statistic greater than 1.96. Let me see. So the t-statistic, we found a couple greater than 1.96. But only a couple, right? Like this one, 2.69 and 3.97. Those were the only significant variables, right? So the constant and then the lag 1 volume has an effect on the stock price. Okay, and all the others have basically no impact. So let me go ahead and make a forecast. My computer is running very slow today, so there appears to be a lag. We're doing lags with the time series, and we're doing lags with the screen refresh rate here too. So here's the data frame. Let me go ahead and plot this. We made the forecast, right? So you can see into the future. These are the next 5 days. We can do 2, right? We can do, all we need is the head. Wait, do we have a head and tail? I think we do. Let me get this. I don't even know what this looks like. Let me see it right now. We'll all learn together at the same time. Okay, and go back one. Okay, Control Enter to refresh. So you see the head. Oh yeah, so it does go for like the next, what do we forecast here? Next, 15 days. Okay, forecast steps 15 days. So that's fine. I think 15 days out we can forecast. If you go out further, it's going to get very fuzzy and very foggy, and you're not going to have an accurate estimate here, right? You can't forecast 30 days into the future what the stock price is going to be. Even 15 is kind of pushing it. 5, it's probably pretty accurate. 15, it's going to get kind of fuzzy because you don't know what's going to happen here. But the stock price today is 227. We know that. Where this model is forecasting by the end of the month, August 31st, it's going to be up $1, so 228. I guess tomorrow it's estimating like $1 jump up, and by September 10th, 231. It's estimating 231. It's at 227. So if you believe the model, there is an opportunity for a small gain here. It's going to go up probably about 27, 29, 30, 31. $4, I guess. Like that's the estimate based on this model. Okay, and then if we plot this, I always say a picture is worth 1,000 words, right? You can look at one image and understand what's happening, or give somebody a description with 1,000 words and hopefully they understand, but they may or they may not. So there's the historical price in blue, and the estimate is up $4 in the next 15 days. That's the forecasted closing price. Okay, so it looks like there's a chance to make some money on Apple in the next couple of weeks here. Okay, so there's no guarantee, of course. I'm not saying go ahead and invest in Apple or transfer other stocks. And the model says there's going to be a gain. Well, there may and there may not, right? It's not investment advice. I'm just showing you how time series models work. But knowing Apple as I do, knowing the market and the current state of affairs, the current economy, it probably looks like a decent investment. And full disclosure, I actually bought Apple today, not because of this, pure coincidence, but I looked at it and ran a couple other pricing models, and it looked like Apple was a good buy, so I bought that thing today. So there you go. That's multivariate time series analysis, looking at multiple features in the data set, and univariate time series analysis, looking at just one single feature, which was the closing price. Okay, so that's pretty much it. In a nutshell, I will share the source code with you guys when I post a video. I'll post the code. You can copy and paste it, run it in your own Jupyter notebook, and you'll have exactly what I have. You'll see exactly what I see. So thanks so much for your time. Appreciate that. And as always, enjoy the rest of your day, everybody. Thank you. Goodbye.